We've got an interesting topic that we've been discussing most of the day related to inflation, interest rates, quantitative tightening, easing, central bank activity. So we've got a very esteemed panel here this afternoon for the next 45 minutes or so. And so I first want to introduce myself. I'm Kevin Van Dolder of Vanco Investment Consulting. We are $125 billion of AUA under management, one of the largest fully independent investment consulting firm, and this is a topic we hear a lot from our clients in terms of what can we anticipate over the next 12 to 18 months in the market. Sitting to my right is Mark Anderson. He's the Chief Strategy Officer at National Investment Services. As the owner of the firm with $10 billion of assets under management, Mark is charged with leading the dynamic fixed income asset allocation discussions internally. So essentially he's the bond manager of the panel on interest rates and quantitative tightening. Let's see what else. Mark is a graduate of University of Wisconsin and a CFA by trade. And a fun fact, we're going to do a fun fact on each one of the panelists, is that he enjoys ice fishing, that many of us here in Texas don't have a full understanding of how much fun it really is. Sitting to Mark's right is Brandon Smith, and he's a portfolio analyst at Boston Partners, $96 billion of assets under management. He's responsible for the full array of investment solutions and being the expert on these solutions. He is a chartered financial analyst and also a Kaya by trade. And his fun fact, if he stands up, he is 6 feet 8 inches tall, and yet he's worried about heights. So if he's near a high cliff or in a hotel on a high floor, he usually tries to stay away from seeing what it looks like on the ground. So Martin Schultz is sitting to Brandon's right. He is the International Equity Portfolio Manager at Federated Hermes, and where he is the Senior Portfolio Manager of all things international equity non-US stocks. He has an MBA JD from George Washington University, and as well interesting for Martin is that he has an additional postgrad degree in strategic studies from the US Army War College. So a fun fact is that Martin spent the last 30 years in one form or another in the US military. He's seen and done a lot of things. So those are some interesting things to share when you see them in the cocktail hour later on this afternoon, but we're going to dig right in with a few slides to whet our appetite, but all things related to interest rates, inflation, and central bank activity. And I'm going to turn it over to Mark to share some thoughts on 2 slides of his and then move it over to Brandon.
Okay, thanks everyone. Appreciate your time today, and as Kevin said, I wanted to set the table with a long-term look at interest rates, and what we're looking at on this slide is the 2-year U.S. Treasury yield over about the last 40 years, call it, starting in the 1980s. The red shaded categories there are recessionary times, and the green line is just a simple trend line from the peak of rates in probably about 1983-84 until the here and now. And I cut this slide about 2 weeks ago when the 2-year Treasury was right around 2%. It's now at about 2.50. So it has broken that trend line, and I think it sets the table for what we are currently going through regarding the rise in interest rates. But taking a step back, and I think just to put everything in perspective, at least my opinion, there's a lot that's captured in this particular chart, not the least of which has been a multi-year, multi-decade shipment of jobs overseas, lowering of costs into our supply chain and what we end up consuming, as well as something called the internet came to fore. It was actually invented pre-1980, but everybody started using it, we'll call it in the late 90s and beyond. And I think that, along with technology, has brought productivity up, costs down, and better supply chains up until the here and now. So there are a lot of macroeconomic factors pushing inflation down to very low levels, and that's captured in the 2-year yield. So I just wanted to show that and get us, in the right mind frame here. The next slide that we put up here is something that's going to be topical, especially tomorrow when the meeting of the Federal Reserve minutes come out. They will be discussing how they're going to be doing some quantitative tightening. But as you can see here, this is the Fed's balance sheet, what they go out in the open market and buy, usually treasuries and agencies. And you can see the 2 spikes. One occurred right around the housing crisis when they had to pump liquidity into the market. and the other one was certainly COVID related, and you can just see how high the Fed's balance sheet is right now and where we're coming from. And that's certainly, I would say correlated in some of the recent inflation numbers right now.
Doesn't that just scream inflation? If Larry Kudlow was here, for example, on Fox News Business, wouldn't he be like jumping up and down about what that looks like?
It even scares me, and I look at it every day. So I don't know if my fellow panelists have a comment on that or not, but it's kind of frightening.
And they're equity investors, so usually they're pretty optimistic.
I think
the only thing I would add is it's really interesting to see that because if you think about where the Bank of Japan has been, right? They've been trying to fight deflation for generations, you want to almost say. And they started basically getting involved in quantitative easing 2003, 2004, then they stopped. Didn't think it was going to work, and then obviously during the global financial crisis, when everyone else started it, they didn't, and then the yen obviously strengthened immeasurably, and now we're seeing the exact opposite. And if you look at the Bank of Japan's holdings, they're like that times 10. So obviously their market is more held by domestic sources, but still it is a global phenomena, and it's something that we need to be aware of as investors.
And I'll wrap up my slides here, and this is a look at credit spreads. So it's something that bond investors refer to, and really this is a barometer. The higher the level, the more embedded risk it is for an investor to hold a corporate bond, or at least that's what is evidenced in the market, what they're willing to pay. You can see the two big spikes, of course, were COVID in early to mid 2020, and then again late 2008, 2009 at the peak of the financial crisis. So really the little spike that we've had in credit spreads, it peaked at about 145 in the middle of March. It's since come down a little bit to the low 120s in the here and now. So the credit market at the moment isn't really signaling panic as far as people being nervous, but it is something to watch. Yeah. And that's kind of my slideshow right there, and I'll turn it over to Brandon for some equity stuff.
Great, thanks Mark. Obviously I'm from Boston Partners, a value equity firm, so we'll come at this from more of an equity perspective. What does inflation mean for equities? You can see this chart on the left. This is the S&P 500, which is the trailing 12-month PE multiple, based upon a series of inflation tranches, and inflation goes higher from left to right. So what you can see is the equity multiple on the S&P 500 typically goes down as inflation goes higher. We're kind of underway in that process where the S&P was sitting around a 21 times multiple, and now it's down to around 18 times next year's earnings estimates. The right side just shows a correlation of the 10-year Treasury yield on the bottom axis, and on the horizontal axis, again, the S&P 500 equity multiple. And what you can see is, as you move out to the right and the Treasury yield moves higher, the equity multiple typically moves lower. We think that's important because today we have a market backdrop where there's, in our view, a cohort of equities that are at very stretched valuations, and that's what this slide is depicting. And conversely, there's a cohort of equities that are very depressed valuations and should benefit from rising rates. This page, apologize for the blinking, but when you can see it,
is it blinking red?
It's showing. I think it's certainly a dangerous slide in that it's showing essentially the group of equities in the U.S. that's most correlated with falling rates, meaning they typically do better when bond prices go up and rates go down. This group still trades at an all-time high relative valuation. That's about 1.5 times the multiple of the overall market. That solid line across the page is their average valuation, typically right around 1.0 the market multiple. So you have a group of equities that does very poorly when rates rise, and conversely does well when rates go down. We think this is the most vulnerable area of the equity market. The industries that are most represented here are software, healthcare equipment, and biotech, media. Some of the more growthy sides, areas of the equity market, and certainly from our perspective, in the parlance of Mark and Martin, from a bond perspective, these are longer duration equities, meaning their growth and cash flow streams are typically far off into the future, and so their valuations are disproportionately vulnerable to rising rates. Conversely, if you look at the group of equities, this is the 20% of the U.S. equity market that does best when rates rise. So typically outperforms when rates rise and bond prices fall. This group entered this year trading at an all-time wide discount to the market. It around half the market's PE multiple versus, again, a long-term average of trading at parity. This group is banks, energy, industrial machinery, all areas that have historically benefited from rising rates and inflation, and we're seeing that today with some of these areas, particularly energy, outperforming amid an inflationary environment. So from our perspective, longer duration equities are, at this juncture, a dangerous place to be. We think cyclical value, some of the more pro-cyclical value industries offer the best inflation hedge from our perspective in the market today. And even going a bit further, some of our long-short strategies are really designed to kind of take advantage on the long side of those cyclical value opportunities, on the short side, benefit from hopefully some of the multiple compression that we'll see across some of those growthier, longer duration equities.
It's a good segue to take it from the United States perspective to more global. So, Martin, maybe you can share some thoughts of what you just heard from
Well, first
your
of all,
lens.
Kevin, Mark, and Brandon, great to be here. Great to be here with all of you. Coming back to Texas, always a good thing. I used to have a unit down in Killeen, Texas, and always tough to get to, but it's always a fun place to visit. I think what I find most interesting is there are really we all know this is happening, but there's some major inflection points that are happening right now, and they're having to do with a lot with what we're talking about today. The one is deglobalization, something that has obviously reversed the trend of globalization, which has historically been considered to be a deflationary kind of type of scenario or trend, whereas now it may be more inflationary. Obviously, you've had higher inflation rates. You have supply issues that have now been accentuated or accelerated by the Ukraine conflict. And so those are obviously issues we're dealing with. They're also in the, as was shown by Mark earlier, this long trend of interest rate. Now I think we're in a bond, basically basically no longer a bull market, but a bear market. And so the inflection points on the interest rates is something to consider. And then finally, the geopolitical side has definitely become definitely more fragmented, if you will. You could call it basically run in kind of a currency trading areas. You could talk about an Asian sphere, a North American sphere, a European sphere. But our view is that in the near term, the U.S. is probably the best place in the world. You obviously have a global slowing economy. The U.S. is probably best sheltered right now, but longer term that remains the big question, particularly as it relates to the potential dollar vulnerability. And so China is probably another place, second largest economy in the world. We're seeing obviously a COVID zero policy that's not exactly working, and that's going to lead to further supply issues and that sort of thing. And then finally Europe, which is really closest not only to the actual current conflict, but also is dealing with some of these supply and energy issues. I mean, I don't know if you've seen the PPI numbers coming out of Denmark, Spain, Germany, and the like. They're between 25 and 37% year over year. So we're going to see some major margin pressure. And so at least in the near term, the U.S. is probably a better place to be. Again, I think it's going to lead to a longer term potential outperformance by EM in particular and international as well.
Great. So those are some really good opening thoughts. I just thought I'd turn it over to the audience to see whether you had any specific questions you'd like us to address as a panel. Everyone's really quiet about central bank activity. Well, maybe we can.
Sleep.
Yeah, perhaps. Or maybe just too worried and checking their phones to make sure everything's still okay in the markets today. But maybe I can just turn over to Brandon and Martin as well, and then I'll turn back to the bond manager to just think about what's going on in terms of global threats, and maybe one or two threats or things that you're seeing that you are analyzing in your portfolios and perhaps maybe even reflecting in your portfolios to ensure you benefit from it. So I'll turn it over to Brandon first.
Sure. I think the clear threat is inflationary pressures and that impacting margins. So we're really focused on companies that are able to pass through price increases. I'd say some of the areas that we've seen to be most vulnerable and that we've kind of exited have been consumer staples. That have less. Some of those names, particularly in the food space, have less pricing power in materials, some of the chemicals companies with oil-based raw inputs, particularly in some of the coatings areas that serve auto and construction end markets. We're seeing some pressures both due to auto supply chains as well as some margin pressures. Conversely, rising rates has made certain areas more attractive. I'd say some of the wealth management and brokerage publicly traded companies out there immensely benefit from the short end of the curve moving higher. We've seen energy companies certainly benefit from the rapid appreciation in oil prices, and we think there's still a compelling value opportunity there. The free cash flow generation is some of these companies are kicking off 15-20% free cash flow yields, which is about as cheap as we've ever seen them. So we've been very active. I'd say there's it's a ripe environment for bottom up stock picking in that there's certainly some winners and losers, but I think inflation is the kind of the key risk that lies out there. I'd say that's kind of the known unknown. What always impacts your performance is really the unknown unknown. There's always some of those out there, and I think to the degree that we can insulate ourselves just by investing in well-run companies with good balance sheets with good margin protection, and that's where our focus is.
So it sounds like a good opportunity for active management.
That's our opinion, yes. I'd say both rising rates and rising inflation. We've been in an environment where the cost of capital has been zero. I've heard some strategists refer to this as the everyone wins a trophy environment. Whether you make money or not, your stock price has gone up as interest rates have collapsed, and now for the first time in 40 years, interest rates are marching higher, as an earlier one of Mark's slides showed earlier. So it's a very different environment, and we think that's going to create just higher equity dispersion, just meaning bigger differentials between the winners and losers, which should be good for active managers. And also, you have very top-heavy equity indices, particularly the market cap-weighted S&P with a handful of companies being around 25% of the index. Again, that benefited the index and disadvantaged active managers as those companies were continuing to rise and see multiple expansion, and now we're seeing the inverse. So that should create opportunities as well.
So turning that over to Martin.
All right, so threats, and you covered most of them, Brandon, so I appreciate that background. I think what's also helpful to think about, if Kevin, you had asked me this 6 months, a year ago, what keeps you up at night, and I get this question a lot, it was definitely a basically huge increase in energy prices, and that's what we're seeing. I think on the one hand, globally, we're in a little better place than we've been in the past from the perspective of at least consumers have a little more of a break, particularly here in the U.S. But even around the world, much more energy efficiency, particularly in Europe, is out there. So that it's less of a factor than it once was. But if you think about that coupled with this interest rate hike cycle, this is a global economic or global central bank hike cycle, right? So you can tell that the U.S. Fed is behind the curve when 129 other central banks had already raised rates prior to what just happened here a few weeks ago. So that tells you how far behind they are. And historically, when the Fed started raising rates, it was really bad for the emerging markets. Our thinking is that this time, most of the emerging markets are actually ahead of the game. And in the case of China, dealing with its own issues, whether it's the property market, COVID, and other factors, it actually has some policy flexibility in place. So it's the only major central bank in the world that has actually followed conventional monetary policy. And none of this MMM kind of stuff. And so from our perspective, actually, China is probably a place to be looking. And the other areas I would think that we're looking at are those markets that are not that are what I would call resource rich. So if you think of the BRICS, you think of Brazil, I guess no more Russia, India, China, and South Africa. It's basically the Brazil, South Africa scenario, and Brazil. Those are the places that we're finding some, because of current account surpluses, because of stronger currencies, and in fact, Brazil is probably close to its hiking cycle being over. Now, Brazil has other issues because you've got a very contentious presidential election coming up later this year. But we feel that a lot of these winners are going to be those resource-rich emerging markets, and even in the European sphere, the Norways of the world, or in Southeast Asia, the Malaysia of the world, that have some resource backing and the ability to weather this current storm, but with both inflation as well as hiking interest rates. So what keeps me up at night remains higher energy prices and higher interest rates.
What's interesting is you brought up Russia, and I had a client meeting last week where one of the chairman was just talking about GDP differences between Texas and Russia, because the GDP of Russia is, I think, actually smaller, depending on how you actually calculate it, than the size of the GDP out of Texas, or even other countries like Canada. So it's fascinating to observe how much Russia dominates the headlines. I was kind of curious, Martin, while you're here and your 30 years of experience in the military, what are your thoughts about what's happening in Eastern Europe with the invasion of Ukraine since February 24th? And do you have any sort of thoughts you can share with the investment fiduciaries in the room about how you're sort of reconciling that in your mind and how that affects your ability to manage your portfolio?
Yeah, I think people should be fairly sober about this. We think this is going to be a longer-term conflict. This is not a short-term, there's always this view that, there's going to be a ceasefire. Again, we were wrong in thinking that there wouldn't be a full-scale invasion. And again, I'm not close enough to the scenario as much as I used to be, but I can tell you that from what I'm hearing, that this is going to be a drawn-out affair. Putin's not going to give up. The West isn't going to give up. So it's going to be out there for quite some time. I think it's funny, or it's interesting, Kevin, you brought up Russia. We never thought about how important Russia actually and Ukraine in some ways were to the global economy. I know it's very small, and it's smaller than Texas, but if you think about nickel, if you think about energy, if you think about fertilizer, and you think about neon and other areas that are very important to the, whether it's the electric vehicle cycle, whether it's the global agricultural industry, this will have a knock-on effect. And so the one thing that I've been kind of thinking, and maybe just going back to my concerns about risk management, is we're probably precariously close to an Arab Spring type of scenario emanating again somewhere in the world. You already see what's been going on in Sri Lanka here recently. You've seen some breakout, some things, protests here and there, and some of them are post-COVID related and that sort of thing. But I think when, in spite of the fact that governments are doing their darnest to keep the free market out of their economies by subsidizing energy prices and that sort of thing, but at some point in time it's going to catch up. And I think the one thing we will do expect to see is some kind of Arab Spring kind of inflationary push, political instability situation.
Interesting. Well, I'm going to turn that over now, since the stock managers have dominated the last 10 minutes or so, and turn it over to Mark to talk about the bond markets and what your thoughts are from a global challenges perspective.
Sure. Thanks, Kevin. It was interesting when the fellows were talking here. It reminded me that we do live in a global world, and one of the things we look at every morning when we're managing our portfolios is what has the demand overseas been overnight for corporate bonds in particular, but also some of the other subsectors that we manage, taxable munis being one of those. And I think when I first learned, there are buyers overseas of University of Texas. The overseas buyer, this is generalizing, but they like to go for names that they're familiar with, states that they're familiar with, New York, Florida, Texas, California, known all across the world as far as being a credit that they can invest in, a sovereign wealth fund, for instance. And the idea that interest rates are rising all over the world, as Martin said, China would probably be the most accommodative right now as far as what they're doing, with their interest rates. But it's competitive now in Europe, where they were formerly looking at negative yields in their government bonds across Europe. They're very close to ours right now. They've risen at the same level, sort of in a parallel fashion, still a little bit lower than the US, but not much. So to the extent that there might be less foreign demand for US credit, that could push the borrowing cost up for some of the issuers over here, impacting the margins. Maybe they don't get as high a PE multiple down the road, but it impacts us from a demand standpoint and what that's going to do to the corporate bond spreads and i.e. prices around that. So that's just one very nuanced tidbit of something that a little thing affecting much more. And I think that's kind of how we're trying to approach this little presentation here. So yeah, there's my 2 cents on what's going on there.
That's a good fulcrum point to bring it back to the audience. Going back to the well one more time, any questions for the panel in terms of your thoughts and observations about the global economy? Do I have a question to the left? My left? No. Oh, right in the middle. Yes, thank you. It's hard to see with the lights are blaring down on us. Yes, go ahead, please.
So two questions. One regarding deglobalization. I wanted to get your sense, and if you had a crystal ball, do you view it as something that's here to stay? Meaning that, people could argue when the starting point was, when did it start? Trump's tariffs in China, you see Europe taxing technology companies, and of course America may, take retaliatory measures, and of course that impacting that on inflation. So I'm curious how you guys are thinking about that. And then my second question is, obviously, big word, inflation. That's all we've been talking about, and this is like an unprecedented period for all of us. I think one of the gentlemen on the panel actually mentioned the fact that a lot of managers benefited from the zero rate environment, right? And so right now rates are rising. The skilled managers are going to thrive. So the question I'm asking you is, will we see a fee reversal? Because everyone's talking about passive, active. So do you see that a fee reversal now because it's going to be harder to kind of call those alpha type returns?
So you're saying to the extent there's more positive alpha to capture, maybe it's a good time for managers to start raising their fees for the value proposition? Interesting. Good. So the first question is about global deglobalization. So I'm going to turn that back over to Martin, and then the fee question I'll bring it back to both Brandon and Mark.
Yeah, the question revolves around deglobalization, whether and so my view is that we've definitely hit peak globalization, and I think whether it's the Trump tariffs, whether it's some of the other geopolitical issues between the U.S. and China, whether it's even between the U.S. and Europe, I think we are definitely at a point where we've peaked on the globalization side. You see it, so we travel a lot, obviously not so much the last 2 years, but starting to again. But a lot of the companies that we've been invested in have historically, obviously, whether they're in Japan, whether they're in Europe or elsewhere, they've outsourced a lot of their production and have then obviously then imported those wares back into various parts of the trade, basically, arena. And that has definitely changed. Part of it was led by the geopolitical side. Part of it had to do with, for example, the chip shortages. Part of it had to do with, if you think about just a few years ago, I think the first kind of shot across the bow, I was actually in Tokyo during, I guess it was March of 2011, during the earthquake. And that's where it started, that affected supply chains around the world already. So companies were aware of this potential issue. Then the Trump tariffs hit. Then we also had, as you may recall, this is again years ago, floods in, of all crazy places, Thailand, which affected the Japanese auto industry. And so I think over time, corporations have learned that they can no longer rely on this kind of just-in-time and global marketplace from the perspective of sourcing. And so I think sourcing is definitely becoming more local. I think that is a fact. And I didn't do a very good way of explaining it earlier, but our view is that we're going to have these kind of currency regions, if you will. One is historically was dominated by Japan, most likely now by China, so that's going to be kind of an Asian sphere. Obviously, their Belt and Road Initiative is a big part of that. But then you've also got the European world that is trying to survive both demographically and obviously from a debt perspective. But this also leads, and then obviously you got the North American side. But so this is not just in trade, it's also in technology. So you're seeing whether it's cyber defense, the ability of Russia or China to basically cut out the entire world and have their own basically system. And if you look at whether it's chips, whether it's electric vehicle technology, it's definitely becoming less and less of a globalized. Now, does that mean that it's going to end overnight? No, I think we're going to have these kind of trading regions that are going to be very important. They're still going to be, and they're going to trade between, not as much amongst each other, but intra-trade. So that'll continue, but definitely I think the peak of globalization has occurred, and the question is, again, you'll have areas, times when globalization reasserts its interests, but I think at the end of the day, we do see deglobalization occurring trend-wise, kind of like you saw that longer-term trend, potentially inflection point. So we do think that is inflationary as opposed to deflationary.
Great. Well, I'm going to turn it back to the second leg of that question in terms of fee pressures and maybe fee expansion opportunities to the extent the value proposition of active management becomes stronger. Did we get that question correctly? Good question. So I'm going to turn that over to the bond manager first. Mark, you want to take that?
Sure, I'll wrestle with the fee question, and not that it's a interesting question and one that certainly impacts everybody's business on this panel in one degree or another, but the trend has certainly been lower. And I would say to the extent that yields are going higher, the difference between what a customer may earn on their money and what they're paying for that earning or maybe losing money should be going up a little bit, but I don't see the trend reversing, at least in the traditional fixed income sphere, which we manage. So that means pretty low fees if you get an index for 4 to 8 basis points, depending on what the range is. Active is going to be above that. I will say, and I'll throw just a shout out to active management in general, and especially within fixed income. That's what I traffic in. That's what we know. If you go against a Bloomberg, they bought the Barclays indices a while ago, but that's the name of the index provider, and we're compared usually to those. And over many different time frames, active does better than passive in the fixed income side. And I think so much more better that, it's not phrased very well, just say better, that it more than pays for the fee. So I'll leave you with, oftentimes you get what you pay for. You know, it doesn't have to be from us or me or anybody else here, but in general, I'm a believer in active. And Brandon, maybe you want to piggyback on that, what you're seeing.
Sure. Yeah. From the equity perspective, I very much agree with Mark. I don't see the trend strongly reversing. If anything, if active managers are able to consistently outperform from this starting point in a rising rate environment, perhaps those pressures abate and maybe the fee declines flatten out a bit. But our general approach is we can take a capitalist view when it comes to fees. The markets set our fees just like the market set the price of a house. The active manager community, really is beholden to what the market will pay. And so, to the extent that obviously we've been in a downward trend. I would say, if anything, I think with active management having a strong opportunity to outperform, I think perhaps those pressures abate. But I can't, realistically view a sharp reversal back upward.
Great. Any other questions? Yes. Yes. James.
It sounds like we're in a period where we've got some major secular inflection points and paradigm shifts with regard to, long-term interest rate trend down, shifting up, globalization, going from globalization to deglobalization. On the equity side, it sounds like you're seeing greater opportunities for active management over passive. We've seen over the last several decades more and more institutions going for larger allocations of passive investing. Do you think this is going to be a paradigm shift where active will be the place to be for a long period of time? And then on the debt and credit markets, we've also seen a long-term paradigm shift towards looser and looser covenants, easier credit. Do you think we're at an inflection point for that as well?
All right, go ahead.
Yeah, obviously, well, from an equity perspective, I work for an active equity manager, so you may view my opinion as biased, but
I'm with you all the way.
Candidly, I do believe, and data does support this, that when rates are rising, you typically do see, in higher inflationary periods, you do see higher equity dispersion. That should create a better opportunity for an active manager to outperform. So. I do believe we are entering a multi-year phase of active over passive, really up and down the cap range and across geographies. Part of my view, part of the the fundamentals underpinning that view is that we do still have very top-heavy cap-weighted indices that are dominated at the top by some very expensive companies. We like some of them. I'm not going to cast a negative light over all of them, but for many of them we view as overvalued. And from this starting point, Even most core indices are very growth heavy at this starting point, and that should give an opportunity for an active manager, particularly on the value side, that has some more cyclical exposure and lower valuation exposure, the opportunity to outperform and benefit from rising rates. So I'm quite bullish on the prospects for active management. That's where my capital is personally invested as well, so I'm kind of putting my money where my mouth is, so to speak. But the data does support that when you look at rising rates and higher inflation, you will typically see larger separation from winners and losers, and that should help active managers.
Well, the second part of the question dealt with bond covenants, or basically how many safeguards does the lender, in this case the bond investor, get when they invest with XYZ company. And there's been a lot of weakening of credit standards over the last, well, call it 10 years from the GFC, and most recently with yields being close to zero, there's a huge demand for any type of spread credit, whether it be high yield or corporate investment grade. So to the extent that investors are now getting compensated somewhat by going safer into U.S. Treasury yielding 2.5%, doesn't sound like a lot, but it's sure better than zero from where it was from. So short answer to your question is, investors will demand a little more, so some of the cov-light stuff will start to disappear. That should ultimately be, all things else being equal, better for the investor.
Well, we didn't practice or discuss this question I'm going to ask next, but I'm looking for basically one number from each one of the panelists. So thinking through like next 36 months, next 3 years in your portfolio that you're responsible for. Now I know, Brandon, you've got several portfolios, so you can pick one. What do you think the total return potential, net of all costs, would be for your mandate? Or maybe you can put ranges around it like a consultant would do, but just think about median case scenario over the next 3 years, what you could expect your portfolio or mandate to deliver. So I'm going to put Martin right on the spot first for this. Yes.
All right, I'll go first. Our view is, so in the emerging markets, probably in the 6 to 8% range.
6 to 8.
And then in the international markets, so developed, obviously, we'll see what happens in Europe and Japan, but probably a little lower on the kind of 5 to 7% range.
5 to 7. It's going to be tough to get to an actual interest rate assumption of 7 and 7.25 when your non-U.S. equity manager is in the mid-single digits. Now, Brandon.
Sure, I'd say for our value-oriented portfolio, just given this starting point of valuations are kind of in line to cheap relative to history, they're cheap on a compared to fixed income on an equity risk premium basis, and we are seeing some tailwinds across large cohorts of value from rising rates and rising inflation. Not to beat a dead horse there, but I would expect 8 to 10% per annum. It would be my expectation over the next 3 years from the value side. I'd expect kind of flat to down from the growth side, and that gets you kind of a mid-single digit overall core equity return. Not too unlike kind of the 2000 to 2006 timeframe. We would compare the current market environment most similarly to that market, where value gave you that equity-like return and growth gave you a flat return, and that's simply because we view. If you look at the valuations, a lot of the forward returns from our perspective have been pulled forward on the growth equity side of the market, and you're going to be hard-pressed to find multiple expansion there from here amid rising rates. So, it's been a good place to be, but the forward return outlook on the growth equity side looks a bit diminished from our perspective.
So this is really tough for the bond manager in the face of rapidly rising rates. So you're welcome to adjust the time frame a little more than 3 years, but go ahead, Mark.
Well, I think I'll take it out a bit, but I want to give a hand to my fellow commentators here that I think they're very reasonable, and I'll try to do the same. A lot of times, the expected return in a bond fund, if you look at what's the yield to worst going forward, the aggregate index, as I referenced, is right around 3% right now. Treasury yields are a little higher today, so it's probably north of that. However, an active manager who uses some form of treasuries, corporates, maybe some structured bonds, should be able to do at least 50 basis points better than the aggregate index. So you're talking 3.5. If you put a more active mix of high yield, if you're still comfortable with the underpinnings of growth, in the U.S. and you think credit fundamentals are okay, you might put a little high yield weighting in there. That could get up to about 4%. So being conservative, I call it 3.5 to 4 in a relatively low risk, knock on my knee, fixed income portfolio going forward, and I'm looking out past what's going to be, inflation here for the here and now. So you might be better off, and I'm not going to advocate timing the market, but if you were to wait 6 months, yields could be higher, and then you'll have a better entry point.
Interesting. Back out to the crowd. We got about 4 minutes or so left. Yes, please.
Yes, I was wondering, this is for the equity gap. So are you, since a handful of companies basically is the market right now, are you guys worried about monopolies or government interventions for monopolies? So that's number one. The second part is for emerging markets, since you're talking about China, are you concerned about China, the geopolitical problems that China's maybe looking at Taiwan or maybe interfering with Russia and Ukraine?
So we've got 3 minutes, guys. There's a lot of good questions that are embedded from China to the FANGs and cap-weighted indices. So maybe Martin, you want to take the China first on 1 minute.
China,
But we appreciate the question. That's a really good question. Wish you had asked it earlier in the session.
Yeah, so I think with respect to China, it's obviously the second largest economy in the world, so it's a little different from Russia. We also think that obviously the geopolitical situation is going to dictate a lot of what happens in the future. And from our perspective, though, I think there's going to be a coexistence to some degree. And again, if you think about, China was up to 45% of the emerging markets index last summer. It's down to 32%, whatever it is now, 31%. So it's not, you can't just remove it tomorrow if you wanted to go that direction. I don't think, again, what China is doing is tiptoeing diplomatically in this scenario, right? Because on the one hand, they share a very, very long border with Russia. They've had both unfriendly and friendly relations over the many, many years. And yet, the biggest beneficiary of what's happening right now is China, because they're the ones that are going to potentially get Russian energy and resources at a cheaper price directly sold to them, as opposed to having to go abroad to Africa, to Latin America, and elsewhere to source some of these areas. So I think that's important. And then the one final thing I will say, and hopefully it's a great segue to where Brandon's going, on basically the trust situation in terms of concentration of power. China has, as part of its common prosperity, has already worked on that to some degree, right? I mean, the Alibabas and the Tencents of the world are fairly cheap, actually, relative to what they are in the U.S. I think the U.S. FANGs come upon us is coming. That's my personal view. When they're able to basically buy all of, you go to Ring, you go to EEB, Amazon, they own everything. There's a problem. But anyway, I'll let Brandon maybe nail it at the end.
Yeah, sure. I'd say in general we are underweight that group. The FANGs, so to speak. Although Google seems quite reasonably valued in cash generative, and that's one of the names there that we do like. But if anything, I think the regulatory scrutiny will negatively impact their ability to acquire competitors in the future, and so that may level the competitive playing field way down the road, so to speak. Facebook probably won't be able to buy a WhatsApp again, and so that certainly may level the competitive playing field. But near term, we still see very strong revenue growth from these companies that continue to dominate, the advertising market, particularly Facebook and Google. If anything, some of the self-policing we've seen in the space has already started to negatively impact a company like Facebook, where Apple has changed its privacy policies, and that's resulted in just less targeted ads for Facebook, which showed up in their recent earnings report. So we're already starting to see this, and I'd say the valuations are beginning to reflect some of these pressures where I mentioned there are some companies at the top of the market that are very expensive, but when you look at a Google or a Facebook, they kind of trade roughly in line with the market for borderline monopoly. So near term, we don't see significant negative impacts, but longer term, the competitive playing field's probably a bit more leveled.
Right. Well, thank you, and please join me in welcoming or thanking the panel and their thoughts and reactions to interest rates,
Thank you all.
inflation, and
Thank you very
central bank
much.
activity.
Thank you.
Thank you.